Assalamualaikum, my name is Nurhidayah Binti Zaidi and I'm going to present about Chapter 1, which is Introduction to Financial Management. Under finance, there are three areas, which is investment, managerial finance, and financial markets. So, what is financial management? From SN Maheshwari, financial management is concerned with raising financial resources and their effective utilization towards achieving the organizational goal. The goal of an organization is to maximize the shareholders' wealth through maximizing the price of the firm's common stock, which means it needs to make sure that shareholders gets maximum wealth through maximizing the price, like making a business. So, why the objective of the firm is to maximize the shareholders' wealth than profit maximization? There are three reasons for this curiousness. First, time patterns of the returns. Even though a large return is expected in 20 years, some shareholders would wait that long to get their first return. Second is risk. Normally, the higher the return, the higher the risk, right? So, if the financial manager aims to maximize the shareholders' wealth, he will consider the risk of the project undertaken. Then, the market price of the stock may be less. But, if the profit maximization is prioritized, the financial manager will look for a high return, but the risk is not considered. Lastly, dividend policy. A firm that prioritizes profit maximization will never pay dividend. Sometimes they experience increase in earnings without favorable change in market stock price. But when earnings increase accompanied with payments of dividends, it will affect the stock's value. There are functions of financial manager which consist of 5 functions, which is performing financial analysis, financial forecasting and planning, financial decision, making investment decision, and asset management decision. Performing financial analysis. A financial manager needs to know how to transform financial data so that it can monitor the firm's financial condition. Financial forecasting and planning. The financial manager needs to know how to estimate the future financing need to support the increase in production capacity. Then, financing decision, which financial manager needs to know how to make decision based on data, cost, and long-run application on the financial condition of a firm. For an example, you need workers to support your business in the middle of a pandemic. So, make a wise decision. Making investment decision. Fix the amount and composition of current and fixed assets needed to be held by the firm to run its business activities. For an example, you have 3 shops. So, rent one of the shops or making a business so that you gain side incomes. Lastly is assets management decisions. Financial manager must manage the firm's assets efficiently to make sure that the firm gets the most benefits out of these assets. Financial markets. It is a marketplace which people buy and sell financial assets like bonds, equities, and derivatives. It divides into 2 markets, which is money market and capital market. So, money market is a financial market to raise short-term financing, which the short-term instruments with highly liquidity are being traded, like treasury bills, commercial papers, and bankers' acceptance. While capital market is a financial market too, for buying and selling of long-term debt and equity securities. Under this market, it divides into primary market and secondary market. So, primary market deals with new issue of securities that involves issuer and the investor. It is considered new as it is the first time to issue to public, or named as the initial public offerings. Secondary market. After the securities has been issued in the primary market, the investor will want to sell their shares that is bought earlier. The investor will approach their stockbroker, then the stockbroker will sell the security to other interested investors in the secondary market. Furthermore, there are advantages of financial institutions to the financial markets. It is to reduce the time and cost of transferring funds. Financial institutions help to transfer funds or capital from surplus units to deficit units. Also, saves times and cost of transferring funds from one unit to another. Then it is to reduce risk faced by the investors and savers. Financial institutions help to minimize any possible risk arises during the transaction as it occurs through specialized financial institutions, which serves as an intermediaries between units involved. That is all from me. Thank you.
Hello and Assalamualaikum. In this video, I am going to present about chapter 2, which is depreciation and taxation under the financial analysis. First of all, the depreciation is the process of allocating the cost of a fixed asset over its estimate the useful life. For example, the depreciation of a tangible asset such as building, machinery, and also plants. And then non-cash expenses, that is a recognition of the expenses that as the asset is used over the time. The depreciation have two parts, which are the annual depreciation and also the accumulated depreciation. The depreciation will reduce the cost of book value of an asset. After that, there are three methods of depreciation, which are straight line method (SLM), double declining balance method (DDBM), and also the sum of year digit methods (SYDM). Firstly, about the straight line method, where it have the same annual amount of depreciation throughout the useful life of the assets. Secondly, which is a double declining balance method, which the rate applied is double to the straight line rate for the depreciation assets. So, under these methods, that's the adjustment is needed if the asset is not fully depreciated. For the third method, which is the sum of year digit method, which it shows that the annual depreciation is greater in the earlier years compared to the later years. And then the salvage value is deducted from the cost of asset. In addition, we move to the taxation, which is the payment or the charge based on the profit of business or disposal of asset. And then the taxation is divided into two types, which is corporate income tax and also the capital gains tax. The corporate income tax that imposed on the operation income, earning before tax, or ordinary income derived from the business operations. The capital gains tax that imposed on profit when a firm sells the asset more than the original price. Besides, the sale of asset has impact on cash flows that create the tax liability. And then the tax liability will increase the amount of tax where the corporation has to pay to a taxing authority. In taxation, it is still used the same method of depreciation, which are straight line method, double declining balance method, and also the sum of year digits method in order to compute the tax liability. Moreover, under this taxation, there is also have the recaptured accumulated depreciation. It is the amount realized from the sale of an asset in excess of the book value, but less than the asset of accumulated depreciation. And then I will show that there are 8 steps in order to compute the total tax liability. I think that's all the learning from the Chapter 2, which is depreciation and taxation under the financial analysis. Thank you.
Assalamualaikum and hi, my name is Nurhidayah Muhammad Badin, and today I will explain to you about chapter 4, which is risk and return relationship. First of all, I will tell the definition for risk and return. Risk, it is mean the potential of which is unexpected events to happen where it can harm your expectation. Then, for return, it is mean the reward we expect to get from what we invest. So, what is the relationship between risk and return? To simply it, positive relationship happen between risk and return because higher the risk, higher rate of return demanded to compensate the risk assumed. Next, we have two types of risk. First, diversified, unsystematic or specific risk. Second type is non-diversified or systematic or market risk. For the first type, which is specific risk, is to particular security and can be eliminated through diversification. For example, include the unexpected death of the company's president, the lawsuit due to defect product sold by company or success or failure in getting contract. Under the second type, for non-diversified, caused by events that affect the stock market as a whole and it cannot be eliminated by diversification. For example, include war, recession, and radical change in monetary policy. Next, the calculation of risk and return. First, the formula for expected return or ER. Second, the variance. Third, the standard deviation or SD. And the last formula is for coefficient of variation or CV. So, let me explain to you how to solve the question about risk and return. So, this is an example of the question. Parkway Incorporation is considering an investment in one of the two projects as shown below. In this table contains the economic condition which is recession, normal, and boom, and investment for XOXO and investment for YOYO that consists probability and return. Then, we need to answer the question how to calculate the expected return, variance, standard deviation, and coefficient of variation. Firstly, we need to calculate the expected return. How to get the expected return? Of course, we need to calculate the probability times return for investment XOXO and investment YOYO, as you can see in this table. Next, you need to calculate the variance. So, how to get the variance? Of course, you need to use the formula with probability times return minus expected returns. So, as you can see in this table, this is how to calculate the variance for investment XOXO then investment YOYO. Then, after you get all the answer, you need to sum up the total and you will get the variance for investment XOXO and investment YOYO. So, the next question, you need to solve the standard deviation. How to get the standard deviation? Of course, you need to use the formula square root for the answer of variance. After you square root the answer of variance, you will get the investment for XOXO and investment YOYO. Next, we need to answer the calculation of coefficient of variation. The formula for CV is standard deviation divided expected return. So, you will get the answer for investment YOYO and investment XOXO as shown. So, based on the calculation, investment YOYO should be undertaken by the firm. Because why? Because it is less risky since it has a lower standard deviation and coefficient of variance. So, that's all how you need to answer the question of risk and return. So that's all my explanation from my video. I hope you guys enjoy and gain more knowledge. Thank you.
Chapter 5, Cost of Capital. There are three sources of long-term financing, which is debt or bond, preferred stock, and common equity that are the sum up of common stock and retained earnings. As you can see in the table here, that's the differences among the sources of long-term financing. You can pause to read it. As you can see, common stock and preferred stock has a few similarities such as no maturity period, both are equity and is called as dividend. What are the WACC and WMCC? WACC, also known as weighted average cost of capital, is a method used to find the overall cost of financing through the combination of at least two sources of financing, and proportionate weight is assigned to each sources of financing. WMCC, known as weighted marginal cost of capital, is a method used to find the cost of capital when an additional amount of capital is raised. Lender may increase the cost of debt when the debt amount exceeds certain limit. Calculation of cost of each sources of financing. Firstly, bond. Cost of issuing bond before tax is called KB, and cost of issuing bond after tax is called KBAD. These are the formula for KB and KBAD. To get KBAD, KB multiply with 1 minus tax. Secondly, preferred stock, that also called as KP. This is the formula for KP. Dividend rate multiply par value of 100 ringgit divided by selling price minus floating cost. Lastly is common equity. Here's are the formula to how to get common stock and retained earning KRE. KCS equals to D1 divided by selling price minus floating cost plus growth rate. Next, example for calculation question of WACC. Given is the latest balance sheet of Kelisa Berhad. Kelisa Berhad needs 100 million ringgit for its latest long-term project. As you can see, the table in the picture here is the balance sheet as at 31 December 2016. Sources of long-term financing. A. For bond, a 20 years bond having 12% coupon rate and issue at 5% discount and flotation cost is 1% of par. The corporate tax rate is 30%. B. For preferred stock, dividend is 8%, price is 2% premium, and flotation cost is 5%. C. For common stock, price of common stock is 50 ringgit, expected dividend is 5 ringgit per share, growth rate is 7%, and flotation cost is 8 ringgit. Personal tax rate is 20% and brokerage fee is 1.5%. In this question, it asks you to calculate the cost of each sources, weight for each sources, weight average cost of capital, and if the rate of return of a project is 16%, should it be accepted? These are the step-by-step answer for calculation of WACC. Question 1. We need to find cost of each sources. Firstly, find the cost of issuing bond before tax, which is KB, and after that, find KBAD. Secondly, find the cost of preferred stock, which is KP. Next, find the common stock, and lastly, find KRE, that also called as retained earnings. Answer for question 2 is calculate the weight of each sources of financing based on the balance sheet given in the previous slide. To get the weight for each sources, we need to divide the book value for each sources with total book value for all sources of financing. For example here, 150 million bond based on balance sheet given is divided with 500 million that are the sum up of all sources of financing book value equals 30%. Answer for question 3. Calculates the WACC. WACC are the total of weight multiply cost of each sources. For last question, if the rate of return of a project is 60%, should it be accepted? The answer is if the rate of the return of a project is 60%, we should accept it since the rate of return is greater than the cost. Next is step in to calculate the WMCC. Step 1. Calculate the cost of each sources of financing, which is KBAD, KP, KC, and KRE. Step 2. Arrange each cost of source of financing according to financing limit. This is table of example of financing limit. Step 3 is determine the book value weight of each source of financing. Formula for weight is book value divided by total book value of all sources. Next, step 4 is to find the breaking point. To get the breaking point of each source, cut off point of each source divided by weight of each source. Step 5 is determine the range of financing based on the breaking point with sort by ascending order. Step 6. Find the WMCC for each range of financing, and step 7 is arranges the project according to descending IRR and calculate the accumulated cost. Step 8 is plot a graph of IRR vs WMCC, and lastly step 9, choose the project which IRR greater than WMCC.
Hi, I will be explaining chapter 6 operating leverage and break-even analysis. Operating leverage means a cost accounting formula that measures the degree to which a firm or project can increase operating income by increasing their revenue. A business that generated sales with a high gross margin and low variable cost has high operating leverage. Fixed operating costs does not change with an increase or decrease in sales or productivity, for example, rent, insurance, property taxes, and salaries. Variable operating costs, a corporate expense that change in proportion to how much a company produces. For example, cost of goods sold, raw materials, packaging, wages, and commission, and certain items such as electricity bills. Degree of operating leverage is a multiple that measures how much the operating income of a company will change in response to a change in sales. Break-even analysis tells you how many units of a product must be sold to cover fixed and variable costs. March 2017, Fnatic Corporation is involved in a business producing refrigerators. Selling price and variable cost per unit is 250 and 110. If the company has a fixed cost per family per year, the company's gain or loss at sell a level of 50,000 units. Profit, total sales minus total fixed cost plus total variable cost. 50,000 times 250 minus 2.5 million plus 50,000 times 110 equals to 4.5 million. The break-even point in units, fixed cost divided price per unit minus variable cost per unit. 2.5 million divided by 250 minus with 110 equals to 70,857 units. 3. Formula to measure degree operating leverage per percent change in interest before tax divided by percent change in sales. That is sales minus variable cost divided by sales minus variable cost minus fixed cost. And then X times P minus V divided by X times P minus V minus F. X refers to unit of production, P price per unit, V variable cost per unit, F total fixed cost. A degree operating leverage that's greater than 1 means the firm has operating leverage. Break-even analysis formula. Total sales equals to sales volume per unit times price per unit. Total cost equal to fixed cost plus variable cost per unit times sales volume. Operating profit or interest before tax equal to total sales minus total cost. Break-even point in RM equals to break-even point times price per unit or fixed cost divided by sales minus variable cost divided by sales. Point in unit equals to fixed cost divided by price per unit minus variable cost per unit or break-even point in RM divided by price per unit. Degree financial leverage equals to interest before tax divided by interest before tax minus interest and minus preferred stock dividend divided by 1 minus tax.
The definition of leverage, Chapter 7 is, it is a debt. Leverage is enlarging effect of using fixed costs on the return to the shareholders. It also uses borrowed capital for an investment expecting the profits met to be greater than the interest payable. The type of leverage. First, operating leverage. It is a business operating risk. We want to know the costs that involve in our business. In this operating leverage also need to minimize the cost and maximize the profit. The relationship between sales and earnings before interest, EBIT, we want to know the cost and the relationship with our income. Fixed costs have to be paid regardless of the level of the firm's sales. The existence of fixed costs, EBIT will increase or decrease at higher percentage than increase or decrease in sales. EBIT also depend on our sales. Operating leverage can be measured by degree of operating leverage, DOL. Secondly, the type of leverage is financial leverage. In this financial leverage, the company have many debt. It is because of the company need to owe money with the investor. The company also need to receive reciprocation toward the investor through by pay the interest and dividend. It is because the interest as our fixed cost. Relationship between EBIT and earning per share (EPS). The presence of fixed cost funds such as debt and preferred stock will result in greater percent of change in earnings per share (EPS) than in EBIT. Interest on debt and dividend on preferred stock are fixed financial costs. Financial leverage is measured by the degree of financial leverage, DFL. Lastly, the type of leverage is total leverage. This type describes the combination effect of operating and financial leverage. Total leverage is measured by the degree of total leverage or degree of combined leverage, DTL or DCL. The definition of point of difference. Point of difference is the level of EBIT that generates the same EPS for combination of two or more methods of financing. Method financing such as interest on bond, dividend or preferred stock, and number of common shares.
How to find point of indifference? First step, construct a table for existing capital structure. Step 2, determine the amount need to be raised. Step 3, construct for each alternative. Step 4, calculate EPS for each alternative. Step 5, calculate point of indifference for EBIT. Step 6, find point of indifference for EPS. And lastly, step 7, draw chart based on EBIT versus EPS such on the diagram and choose which one is the better plan for the firm.